we used to say, half joke that people don't pay any attention until your super balance gets to either six figures or a year's salary, whatever comes first.
No.
Then people start to go, oh, hang on a minute, if this is a non-trivial sum of money and it's mine, I better pay attention to it.
Yes.
But I tell you what, I don't think I know anyone who is approaching retirement or in retirement who tells me, gee, I wish I'd have worried about this later. Everyone says they should have worried about it earlier.
Hello, and welcome to the Market Bull Podcast. Please note, topics and stocks discussed in this podcast are not financial or investment advice. Brian Parker is the Chief Economist at the Australian Retirement Trust, with over $260 billion in retirement savings being deployed for over 2.3 million members. Brian talked about his history and why he has always been fascinated with economics. He talked about the current economic outlook for Australia and globally, pointing to some of the trends within the markets. He spoke about the investment strategy at the Australian Retirement Trust and the ways investors could look to minimise risk. Here is Brian Parker.
So hello, this is the Market Bull Podcast. I'm Ben Kostrich, and joining me on the show today, he has not flown over just to see me, but is Brian Parker, the Chief Economist at the Australian Retirement Trust. They reached out to me because they're coming over to WA to expand the portfolio and a bit of the clientele, and we'll go into all of that. But welcome to sunny Perth.
Good to be with you. Fantastic. Thanks for the invitation.
So talking about yourself, we were just saying you've had an eclectic career from starting at the RBA, making your way to NAB, Citibank, Rothschild, and now to yourself in the position as the Chief Economist. But I mean, your history and almost interest in this side of the world and the economy and economists as itself, how did you venture down this path and to get to where you are now?
Oh, look, at the end of the day, it goes back to when I was a teenager, when I was frankly a bit of a geek, and I was really into politics. And this is the 1980s, right? And back then, if you were interested in politics, you almost certainly were interested in economics as well, because economics was front page news. This is when Bob Hawke and Paul Keating were turning the country on its head in a really good way, and markets were being deregulated. It was a really exciting time to be in financial markets. And I just saw what was happening, and I said, I want to work in markets. I actually want to work in economics, and I want to work in markets. And so that's what I ended up doing. So I got into an economics degree at UQ, did honours, realised I actually quite liked not working terribly hard for a living, so I hung around and taught economics for 2 years. Then I thought I better get a real job. Then I thought, okay, I better get serious. And so I got a job at the Reserve Bank, which was wonderful. So I worked in their international department, which is very much a market business. That's where they manage Australia's foreign reserves. That's where they do foreign exchange intervention and things like that. And so that was very much, it was like working for a global bond and currency manager within the Reserve Bank. So I did that for a few years or 2 years, then joined the markets, mainly worked in asset management on the investment side of things, but also spent time in treasury dealing rooms. And it's been a lot of fun, a wild ride over 30 odd years.
And have you found that there was a particular asset that you started, I guess, falling in love with more than others? Because I mean, breaking that down for so many, you'd go, everyone's got their own idea of what an asset is. But I mean, when you're talking about that, where did you find your sorts of interest lays?
Look, I started my career in bond markets, which is not terribly exciting, or most people don't find them terribly exciting. But back then it was terribly exciting because, Australia was transitioning from being a high interest rate, high inflation economy into being a much more normal economy in that sense from an interest rate and inflation perspective. So bonds were just performing brilliantly. So that bond market rally just was phenomenal, absolutely phenomenal. And so being part of that and actually trying to pick, well, how long does this ride last? Just how low interest rates go. I mean, there was a really, really challenging time. It looked easy, and with hindsight, it might have looked easy, but it was a real challenge because there were plenty of people who just didn't believe the story, who basically said, oh, if it doesn't change its spots, Australia was going to go back to the bad old days of the 1980s, but that didn't happen. But bonds were exciting, and bonds were sort of like the cornerstone, if you like, of any investment portfolio. That's your risk-free race, that's the defensive part of your investment portfolio. But as I moved on in different parts of my career, I started to work not just in bonds, but I worked in economics, I worked in asset allocation, so deciding which asset classes to be in, advising investment teams. More recently, working with people who work in private markets, so people doing infrastructure deals, private equity, real estate, to the extent that the macro case that they're looking at, they're deciding to buy a piece of infrastructure, anywhere in the world. As part of that, they look at the macro environment in the country they're in or the country they want to invest in. And so sort of helping them kind of, assess the macro risks and macro opportunities associated with particular transactions. And that's kind of fun.
Gotcha.
And that's certainly been part of what I've done at ART. But most of the work I've done over my career has been very much macroeconomics, asset allocation, and communication. So getting helping to kind of manage the money is kind of half the time. The other half the time is getting out and having a chat about it. Hence we're here.
Like on a podcast like today.
Correct, absolutely.
So then, your pathway to then joining the Australian Retirement Trust. You've been there, let's say, nearly 9 years now. How did you venture into that, and then how has that, over this 10-year period, you could say, just evolved and adapted, especially given the current sorts of clients that we're going through?
It's a really, really good question. I joined what was then Sun Super in 2015, which was a Queensland-based, I was going to say industry fund, but profit for member fund. I really wanted to get onto the profit for member / industry fund side of the industry, because at the end of the day, I like the idea that I'm at the end of the day managing money and helping to make decisions on behalf of members, on behalf of clients who depend on professional investors for their long-term investment outcomes and retirement outcomes. And to do that in a very conflict-free way, we only have one set of clients, and they're the members of the super fund, and there's no shareholders that need a feed. It's all about doing the best job you can for the members, and that's it. That was really appealing. So when I got the phone call saying, do you want to come and work for Sun Super, I kind of jumped at the chance to move to that. Plus it also meant I could stay in Sydney, which is also kind of cool.
Very nice. And then that whole company, the history, because that's evolved a lot now over the time. What's been happening to get where it is now?
Oh, look, it's a really good question. Grown a lot. Back then, I think we took the view that you either got big or you were going to be forced to merge with somebody. And I think there was a view that, maybe if you had $20 to $30 billion under management, you were pretty safe from being maybe swallowed up. But I don't think that's true anymore. I don't think it ever was true, to be frank. And so the organisation decided to pursue a fairly aggressive growth agenda. And that meant you had to get fees down, you had to maintain strong investment returns and attract business. And so as part of my role, especially my external-facing role, it's not just talking to our existing members, but also talking to financial advisors who are increasingly interested in looking at industry funds, looking at profit for member funds, as opposed to the traditional retail offerings. So that's been great, and we've certainly grown that book dramatically over the last little while, but also growing the corporate client base. We've now become almost the corporate superannuation fund provider of choice, really. So we've certainly grown that book very substantially. Not just, certainly outside of our Queensland base in particular. So much of the corporate client base is actually south of the Tweed River, and it's still growing.
Yeah, and you mentioned there about getting returns, and I think without a doubt the past 10 years at least you would have seen some very sporadic and ridiculous sort of market conditions and economic structures.
Yeah.
If you're summarising in particular this last sort of 2 to 3 years and what we're going into, how do you characterise or describe the current state of the Australian markets and where we could be going?
Let's go back beyond 2 years if I can, right?
Yeah.
Let's do a little thought experiment. Let's assume you started your career like 10 years ago or so. And as part of that, you started your first job, and someone in HR or payroll gave you the details of the company's superannuation fund. And they gave you the prospectus or the product disclosure statement, as it's now called. And then you did something remarkable. You actually read it.
Yes,
now, when
true.
you read it, it would have told you what sort of return expectation the super fund thought you should have. And back then, they would have said something like, okay, if you're in the balanced portfolio, which is where most people end up heading, we think that after fees, after taxes, and after inflation, we think we can do maybe 4.5%. So a real return of about 4.5%. Stroll forward 10 years and let's look at the journey. It's actually been a fantastic journey. In fact, the returns that a typical super fund has delivered over that period has been miles higher than that. Even some funds that actually failed the performance test their members maybe were really, really surprised because they would just look at the absolute returns and say, but the fund did fine. Because back over the last 10 years, even though there were plenty of setbacks along the way, you had the Euro crisis where Greece was going to go back to the drachma, remember? You had COVID, you had Trump, which is pretty much a single man crisis. But basically there was plenty of ups and downs along the way, but if you draw a line through it, the returns have been phenomenal. And a big part of that was that, interest rates were pretty much falling consistently. Yeah. There was lots and lots of liquidity injected into the system during the GFC and afterwards. That liquidity never really went away. There was a lot of money chasing assets, and it was kind of the kind of environment where a rising tide lifts all boats. Yeah. So it was a great time to be an investor. Now that's the rearview mirror, which is kind of interesting, but the windscreen is more useful. The windscreen looks more challenging, and the windscreen looks a lot more challenging. Whether it's the geopolitical environment, which is absolutely more challenging, the inflation and interest rate environment, which is clearly more challenging, and I think we are in the midst of a more difficult period. If I think about inflation, the worst of the inflation story is probably behind us, but I don't think we're going to go back to the kind of really low inflation rates we saw pre-COVID. Yeah. The problem the central banks had for much of that period was that inflation was actually consistently below their target. Now it's like, how can we get it down to target and keep it there? That probably means that interest rates and inflation are going to be a little higher than we've been used to, and that is going to be more of a challenge for the central banks. But the geopolitical environment doesn't help that either, because one of the things we found over many, many years is that, in a world of globalisation, one of the things that kept downward pressure on inflation was that you could source cheap stuff from anywhere in a globalised world, right? Now that's kind of changed. Do you really want to be reliant for some really, really key stuff, whether it's key components in your manufacturing process or really key pharmaceuticals or medical supplies in a pandemic? Do you really want to rely on a country that doesn't like you very much for those supplies? Yes. Probably not. And so trying to introduce some kind of assessment of geopolitical risk into how we manage supply chains and where we get stuff from, that probably means that supply chains might be less risky, but they're also more expensive. So a whole range of things that actually kept inflation under control are perhaps not as helpful going forward.
Yeah, well, I think about it like what you said there about getting your super fund and then getting a dossier document and just pretty much ignoring it. And I can think when I first started work, that's exactly what happened to me. Absolutely. I just got given one through one of the big organisations I worked at, and I think from my point of view, I've never really even looked at it or considered it. I just go, the money's there, and I think that's probably for a whole host of people within my age demographic and even older.
It's true. It's the rough rule of thumb. I don't know what the rough rule of thumb is now, but we used to say, half joke that people don't pay any attention until your super balance gets to either six figures or a year's salary or whatever comes first. No. Then people start to go, hang on a minute, this is a non-trivial sum of money and it's mine, I better pay attention to it. Yes. But I tell you what, I don't think I know anyone who is approaching retirement or in retirement who tells me, gee, I wish I'd have worried about this later. Everyone says they should have worried about it earlier. I'm kind of lucky I have two young adults now who both, by virtue of who their father is, have paid attention to their super. Yes. Yeah. Not that I would ever offer them financial advice, but they certainly don't take any advice from me. But they're very, very financially savvy and financially aware. So they're clearly not going to be typical because, I'm their father. But I'd hope that if there's one thing we can change about the super system, get people involved earlier, get people to engage with their super earlier. There's no downside of that and a lot of upside.
Because that's the other bit, is like engaging with it. I'm still speaking for myself personally, is that I've just never really thought about what I could do with it because maybe that's smaller money. And then when you do sort of get further down the line, you're like, well, you're doing your own self-managed or what are the sorts of ideas that are going through your head? And from the sounds of this, I've been listening to podcasts myself, Diary's CEO, and there was a conversation about this idea of just patience and just staying the course. And, something like this, it's a return over 20, 30, 40 years, but we're just in this sort of environment nowadays where we just want things now instantly. And we've seen an influx in, I guess, day trading and people having their own CMC or stockbroking account. And then they've all just gone, no, stuff this, I don't want to do it. And that's where liquidity just dried up.
That's true. And it's funny though, when stock markets are running hot, because like I said, I've been in this industry a long time. I do find that when markets are running hot, you do tend to see a lot more ads for people encouraging you to trade. Yeah. Right. Because if markets are just going up every other day, it looks kind of easy, right?
Everyone's a genius.
Everyone's a genius when the market's running hot, right? But as they say, when the tide goes out, you see him swimming naked, right? And the tide is going out.
Yeah.
And so investing is actually quite hard. And patience is, especially for superannuation, especially for planning your retirement, patience is an absolute virtue. Think about this, like over the course of let's call it a 40-year career doing something, okay? How many recessions are you going to go through? You're probably going to go through one. Pick it up to 5. How many major market events, how many major stock market downturns are you going to go through? Maybe 15, maybe 10, I don't know, pick it over again. There may be, you'll have to experience several, maybe more, fairly significant regional conflicts in the world, a la what's happening in Ukraine, a la what's happening in Israel and Gaza right now. There's a whole litany of things that will cause financial markets and cause you as an investor
To do something sort of
correct, potentially do something really dumb.
Yeah.
And that is a real challenge. And because we can't really predict reliably when these things are going to start, we can't predict when they're going to end either. But we do know one thing: they all end.
Yeah.
At the end of the day, life and business and the universe goes on. And yes, there's lots of volatility along the way, but your reward for putting up with that crap is a much better long-term outcome if you're prepared to be patient. That's really the secret to it. But it's very hard to encourage people to be patient when, some of the news headlines are looking pretty dire. The world is not a happy place, and there's no point in trying to sugarcoat that. The world is not a happy place, and even if peace were to break out in the Middle East tomorrow, or if peace were to break out in Ukraine the day after, there's still a range of geopolitical risks which could potentially cause a lot of stress for markets and for investors.
Yeah, because that's the interesting just of evolution, really, because I saw COVID just amplify just people's awareness of everything happening globally to an extent that, social media's helped, but this just went.
Hey, you're right.
Like a fire, and then everyone's
right.
now engrossed in everything, and it's so instantaneous that people are so quick to just judge something they see and then make a reaction. And I think that's one of the struggles almost is selling it, or being a super is almost forcing or encouraging people to say, look, you can't react to these things sporadically because you need to have a 10, 20, 30, 40 year game plan about it.
And I tell you what, mind you though, yes, and that's absolutely correct, right? But during COVID, especially when people have not had, that is we haven't had an experience like that for over 100 years, right? It was a once in a 100-year pandemic. And so people thought maybe this is different this time, and I actually am going to get out and hide money and cash because clearly this is going to be dire. Now, the disease, dire, right? And millions of people dead around the world. But from a financial markets perspective, COVID lasted, 3 weeks?
Yeah.
And that was just astounding. I remember at the time, we were certainly seeing some of our members, relatively small numbers, but still some of our members moving quite large amounts of money out of balanced and growth type portfolios into cash and conservative portfolios. And it won't surprise you to know they did it at pretty much the bottom of the market. And sadly, they kind of shot first and asked questions later. They got onto the app and they switched pretty quickly, but then thought, I think I might have done the wrong thing. I better get some advice. Oh, gee, I think I've done the wrong thing. You reckon?
Yeah, there's no going back now.
There's no going back. And you have made a permanent loss of your capital as a result. That's sort of illustrated to us the fact that, financial advice works, absolutely. Getting professional advice works. Secondly, making sure that, preferably with the aid of advice, that you're invested properly for your stage of life, your appetite for risk, your financial goals. If that's the way you're invested, you're far less likely to do dumb things at the bottom of a market.
Yeah.
That's the thing. We just see it every time. Every time there's a major downturn, you always see people making poor investment choices. You wish that it didn't happen, but sadly it still does. But what we also find is that those of our members who get advice are much less likely to do that, but also those of our members who are disengaged and are just sitting in the default option, most of them didn't move. That's a good thing, by the way.
Yeah.
Because the last thing you want is members becoming engaged in a really dangerous way at the wrong time, if that makes sense.
Yeah. And I mean, that's why it's sort of this preaching of, finding advice or finding those people that you listen to not necessarily talk you out of it, but just recompose you, because there's this just sense that people get jittery and just act emotionally.
In a way, we've made it so easy to move. You can pick up your phone and switch your portfolio in a heartbeat. And that's fantastic technology, but it's also potentially dangerous if you do that without advice. It goes back to the point we made before, is that why was the last decade such an amazing period? Because there was the world with awash with liquidity. Well, that liquidity didn't go away during COVID, it was still there. And as soon as markets started to really tank, that liquidity pounced. we absolutely thought, here's a great opportunity. We managed to put some money away.
Massively oversold.
Absolutely. We just thought, here's some chance to really buy some decent assets. So we got some money away, absolutely, but nowhere near as much as we thought we might, because things turned around so quickly. And for us, it was kind of a balancing act, because on the one hand, you needed liquidity because you had members switching to cash. You also then had the government's early release scheme, which we paid out about something like $3.5 billion under that scheme. And so we managed to meet those demands for liquidity, but also have enough cash that we could actually deploy.
Yeah.
But like I said, I think we were certainly expecting to see a lot more opportunities to buy cheaper assets, opportunities that would have lasted longer than 3 weeks, but there you go.
And especially at the moment then, how is the trust sort of adjusting or positioning itself, given that it's still a very, sporadic market, but if you're picking those sorts of sectors that you're just backing for a certain period of time, then what sort of involvement, or where are you guys looking at sort of focusing?
Yeah, there's a few things I'd say. Firstly, just think about the traditional asset classes, so shares and bonds and cash and TDs and stuff, right? Now is actually a much, much better time to be invested in bonds, at the risk of stating the bleeding obvious. Several years ago, when bond rates were yielding, 2/10 of stuff all, there was very little strategic value on offer in bonds. Now there kind of is. So at a strategic level, if I think about our long-term strategic asset allocation, we've added back some bond exposure. But even at the sort of what we call our dynamic asset allocation, where we're more active and we can take advantage of market volatility, you've seen a sharp rise in bond rates in the UK, US Treasuries, even Commonwealth government bonds here. So for the first time in quite some time, we're actually overweight some of those bond markets relative to our sort of benchmarks, because finally there's a bit of value there, which is kind of cool. Doesn't mean equities look disastrous or anything like that. It's just that we're still finding value in equity markets. But certainly for the first time, you can actually say that the future returns from bonds actually look quite reasonable. The other thing we've focused on as well is the private markets, and a whole range of the profit for member funds, the industry funds, have long been investing a significant part of the portfolio in things like private equity, infrastructure, real estate, private credit. There's still plenty of opportunities in that space. Yes, you need to be careful about what you pay for an asset, but that is always and everywhere true. But we're certainly able to use scale to actually buy really big, diversified, really well-diversified portfolios of these assets. So you're not talking about an infrastructure portfolio of a couple of airports and a few roads. It's hundreds of assets. It's literally thousands of private equity companies in the book.
And again, is this just Australian focus, or is this is like the global focus? That's another thing to get across, is that this is looking at opportunities not just in Australia, but everywhere.
Global. At the end of the day, we are a relatively small pond. The superannuation industry is now somewhere north of $3 trillion. Australia's GDP in any given year is what, 4 trillion. You can't limit yourself to
just Australia.
You can't limit yourself to just Australia. You can't limit yourself to just the traditional markets. We've got to invest something like $270 billion of other people's money. We need the broadest possible opportunity set we can to actually generate returns for members. And that means making sure that, yes, we're absolutely invested in traditional bond and equity markets here in Australia. We're a major investor in the Australian equity market, obviously. But having the kind of global reach and global access is absolutely crucial. When I started in the industry, 30 odd years ago, if you went to London and New York and seen you from Australia, people would just go, oh yeah, that's nice. Or they might make some crack about Paul Hogan and kangaroos. But you weren't viewed as someone that they should necessarily spend time with, because Australia was just small beer. That we just didn't have the kind of financial clout. Now, if you turn up in London, New York, and you say you work for an Australian super fund, you can get to see pretty much anyone you want. Because we are now a globally significant a collection of asset owners. And the kind of access we now get is just streets ahead of what we saw many years ago. So you can get in, you now get more seats at more tables in terms of investment opportunity, and that's a really, really good thing.
And another point that we're sort of grappling towards very quickly is this electrification future, because everyone's focused on environment and making it a better place for the future, and governments have set legislations and objectives, but ESG has now become almost a paramount investment vehicle, or something that everyone needs to consider. And I see it as like a flip of both coins, because there's definitely pros to it, but then there's definitely some sorts of issues if you're just going full on ESG focus in particular. And I just want to know how those sorts of decisions are impacting the fund as well.
Yeah, we certainly apply an ESG lens to every investment decision we make. We insist that our managers do the same thing. For us, it is both. I would argue that any decision we make on an ESG basis is at least as hard-nosed as any investment decision that we make.
Yeah.
This is about looking for opportunities and managing risks. That's what it's about. We don't want to be overly exposed to companies that have really bad governance because they could end up destroying value. We don't want to be exposed to companies that are just not good corporate citizens. Even if you just think about the potential for litigation, if you think about the potential for adverse regulatory outcomes, being a good corporate citizen, having strong governance, it makes you a more attractive investment proposition. So this is very much about. It's very much a return-focused thing. This is not a feel-good program.
Yes.
Okay.
Yeah.
On the environment, again, it's risk and opportunity. The world is transitioning, whether we like it or not.
Yeah.
If I think about that transition, that means we do not want to be overexposed or indeed exposed to assets that are going to be potentially worthless in 15, 20 or 30 years' time. The companies we invest with, the companies that we invest through, we expect them to be aware of these issues and have a plan in place to try and manage their exposure and to, at least in the first instance, to measure it and then to manage it and adapt over time. There's also opportunities out there, right? At the end of the day, there are solutions out there. There's exciting things happening and a whole range of energy-related technologies that will be part of the solution. So we want to make sure we have a seat at those tables as well. If you think about it from the energy space, which is the most most high-profile area of discussion, our job as an investor is to keep the lights on short, medium and long term, which means do we still have assets that are exposed to fossil fuels? Absolutely.
Well, that was what I was going to ask.
Yeah.
Because that was one of the best returning assets last year.
Absolutely.
The stock because everyone needs their lights on at the moment.
Absolutely. And this idea that in the short to medium term, you're not going to have any fossil fuel exposure. You will still have some. You'll have to. The people who are very, very active in this space basically say, yes, there is a future for renewables. There's a massive future in battery storage. There are still discussions about nuclear, but the progress we've made in battery storage is enormous. The cost of wind and solar has come down dramatically. There is still a potential role that people debate about, I know, but this idea of having gas for what they call firming the system, and you can actually have a gas facility which is not 100% in operation all the time. It's not constantly burning lots and lots of gas. If you have a coal-fired power station, you can't turn that on and off as easily as a gas-fired station. So if you have a gas-fired facility as a backup for wind, solar and battery storage, you're increasing the reliability of the system, but the greenhouse gases you're emitting by running gas as opposed to coal, it's much, much less. Absolutely. Where the future lies, we just want to make sure that we're positioning so that we don't know exactly what the future looks like, but we want to make sure we've got a seat at the table. We want to make sure that we're managing the risks and looking for opportunities on behalf of members. And as I said, that is an investment decision. It's not a feel-good decision. Our job is to basically generate best financial returns for members. And that's managing risk and generating returns. That's all we do.
And I mean, again, when you're investing in and you're picking your assets or your companies or whatever it is to invest in, I mean, have these got sort of preconceived ideas of the length of how long you're going to be in each of them? Because I'm looking at this like, an everyday punter that wants to chuck a few thousand on a stock or whatever they want to invest, they can sell it whenever they want. But I know as soon as you start getting bigger parcels of a company on the share registry, there's a bit more, I guess, difficulty potentially in just selling, especially the full allotment. So, how does the fund or how do funds, I guess, manage this as your portion gets larger and then you have to, as everyone does, take some off the top? I mean, how does that also work?
Look, at the end of the day, there's a few things I'd say there. Firstly, in the private asset space, for example, you don't buy an airport expecting to sell it in a month's time, right? You're going to hold that for years.
Yes.
So most of our sort of real estate assets and private equity, real estate and infrastructure in particular, we sort of buy into them with a view of we're going to hold them for many, many years. Not forever. At the end of the day, if someone rings you up and offers you a nuts price for something you hold, you have to have the conversation.
Yes. Yeah.
If someone's going to, be a complete wood duck and pay you well above the odds for an asset you hold, your duty bound is members' best interests. If I can sell it and I can reinvest the money somewhere else and get a better return, happy days. But if I think about the traditional markets, and you're quite right, we're not trying to sort of we've got a multi-billion-dollar equity portfolio. We are not churning and burning that portfolio on a daily basis. At the end of the day, and we use external managers. We have a core part of the portfolio which is passively managed, and that portfolio is not turned over very, very much. You replicate the index and you hold it. And any trading is very much related to inflows. That's really about it. The active managers we use, and we do use active managers in Australia and international shares as well. If they were turning over the portfolio every 5 minutes, we'd be really terrified about that, because we would say, sorry, you're meant to be an investor, you're not a trader.
Yeah.
So there is an optimum level of turnover for these guys. It's not zero, but it's not 500% either. So a lot of these managers will tend to hold a core group of stocks that they will potentially hold for some time. They're not going to hold them forever. At the end of the day, we expect them also to actively manage the portfolio. That's what we're paying them to do. But the core part of our portfolio is, as I said, quite passive. Turnover is a cost. And every time you turn over the portfolio, you better be sure that the reason you're doing it actually is going to be either profitable or it's for reasons of inflows and outflows, and you can't really avoid that.
Yeah. And I mean, as we're sort of spiraling towards the end of this year and I guess onto the future, it's very hard to get the crystal ball and predict what's going. But I mean, where do you see Australia sort of transitioning or really leading in some regards, or maybe the global stuff, but Australia, where are we sort of taking charge in driving potential returns on investments?
Oh, it's hard to say. Look, firstly, we're in for more volatility. The world's a very, very unhappy place, and I can't see it, magically becoming happy at the end of the week. Australia, to me, if I think a bit longer term, Australia is reasonably well placed. Take the sort of call it the green revolution, the materials, it's very mining intensive. We'll still be mining a hell of a lot of stuff out of the ground of Australia. We may be mining different stuff in 20 or 30 years' time, but we will be mining lots of stuff, because that energy transition is going to be very, very mining intensive. Okay, and I think that is a good story for Australia in general, particularly WA where we are. That's one thing. Secondly, I'd say Australia now is a less risky investment proposition than perhaps we've historically been viewed. Now, again, I'm old enough to remember the 1980s. We used to go apoplectic about our monthly current account deficit figures, our balance of payments. We were all going to be a banana republic by now. We were pretty much going to go the way of Argentina by now. Okay, none of that ever happened. Okay, one of the reasons is that if you look at Australia's balance of payments today, since Europeans arrived here, we run a current account deficit, which means we've always relied on foreigners for capital. Okay, we've imported foreign capital, either debt or equity, consistently over 200 years. Something dramatic has happened in the last few years. We're now running a current account surplus, which means we are now a net exporter of capital to the world. The days when Australian businesses had to go cap in hand to foreign investors, please sir, can I have some more so I can fund this particular project or whatever that I want to do, that doesn't happen so much. If anything, foreigners now come to us, because we are now a source of capital for the world. It goes to my point before about the kind of access we get as Australian super fund investors. That change in Australia's balance of payments position, and one of the RBA speeches recently addressed this and talked about that change and how significant it was. I think that fundamentally changes the world's perceptions of Australia. And given the state of the world, just geographically, I think I'd rather be here.
Yes. Yeah, no, I think we've seen sovereign risk impact a lot of investment decisions recently as well.
There's one conundrum there, though. The Australian dollar is still behaving the way the Australian dollar does, which is kind of weird. So, it is still pretty much a barometer of global risk appetite. We had this big debate internally, where we basically said, well, the current account position is now fundamentally changed. There's reasons why you might actually think the Australian dollar is a lot safer than it previously is. Is the Australian dollar still a risk barometer? And the reason I say that is that if you wanted to build in some defensiveness into your portfolio in the last few years, especially when bonds were yielding you stuff all, you said, well, if I want more defense in my portfolio, I don't want to rely on bonds because the yield's pathetic. What can I do? Well, the lesson of COVID is the Australian dollar is still going to do what the Australian dollar is going to do. It's going to sink like a stone when things go crap.
Yeah.
So, in other words, having some unhedged international share exposure in your portfolio still helped to smooth the ride for members and for clients during that really tough period. But it's interesting, that's still the way the Australian dollar is behaving, but yet we've had this fundamental improvement in our external position. It's a conundrum at this point.
Yeah, very much. I mean, that's the fascination with just the markets period, and just this, everyone's trying to figure out what's happening, and that's why so many people have spent so many years like yourself just focused on it, because it's just always exciting. There's something different happening.
It's fascinating. I couldn't imagine doing anything else for a living. I'm doing the job, and this highlights what a geek I was at 15, 16, right? Because I am doing the job today that I wanted to do since I was a teenager.
Yeah.
All I wanted to do was work in markets and have a chat about it, and that's what I do.
Far out. And I mean, there's probably people on the other side, like such as myself, that are listening to this and going like, I've never really considered this, and this has jogged their memory about, looking at your super. And I think from a perspective of you guys have quite a sound base in Queensland, and now you're expanding across the rest of Australia. But I mean, get some insights as to, what sort of demographics are you guys really looking at sort of encapsulating? And you said there, it's quite easy to start looking at switching and adjusting. But if someone's really going, hey, I've had this set up and I have no idea where I'm going to start, I mean, what should people do? What could people do?
Oh, they should absolutely get on the ART website, art.com.au. There's the free plug. Look, we manage money on behalf of all Australians. We have historically had a relatively young membership. The average age of what used to be Sun Super members was in the sort of mid-30s. Now the membership average is probably around 40-ish. But again, that's still relatively young. These are still people who typically have got to have 20 to 30 years or 20 odd years of working life to invest money in, and then they'll start to draw that down. I would encourage anyone to take an interest in their super from a really, really early age. Make sure that you're with a fund that is sustainable. Obviously the interest of being utterly self-serving, I'd love it to be us. But take an interest in your super, and in particular, when you are investing, make sure the investment option that you're in or you choose is right for you, that it's right for your phase of life, right for your appetite for risk. So in other words, you're going to take enough risk to get where you want to be over time, but not so much risk that you're going to lose sleep at night. Sleeping at night can never be overrated. Right? So take an interest, make sure the investment option you have is right for you, think long term about it, because super is the longest term investment any of us are ever going to have, and it's your money. Read the fine print, pay attention to what's going on.
And another interesting bit, talking from myself, there's clearly a rise in people doing things on their own and almost taking on those consultancy or side hustle sorts of projects. So they've got potentially their 9 to 5, but they've got their other things. And one of the things that at least I'm grappling with is, I haven't necessarily got something directly going into my super as like an individual. And I just see that there's this transition from either freelancers or, the rise of Fiverr and some of these things where it's an individual doing it, but then thinking about, well, God, how do I start putting or allocating money to my super? And what do people do there?
You know what I think you got to do, and this is and it's the same with anyone effectively running their own small business, even if it's a small business of one person, right? Is you need a plan, you need a financial plan, and as part of the financial plan, putting something away for retirement, putting something into super. This idea that I do speak to business people who say, look, my business is my super.
Yes, exactly.
Okay? And that's fine if your business ends up being really, really successful and valuable, but maybe just a bit of a hedge. Maybe if that's the situation you're in, so, well, actually, what if my business doesn't work out, or there's a major change in my lifestyle, which means I can't keep doing this business? What do I have to fall back on? So having some super that you put aside, even a relatively small amount as you're going along, I'll call it cheap retirement insurance, put it that way. But you're right, that is certainly been a growing part of the market. Doesn't mean that people don't need to pay attention to super though, it does certainly make it somewhat more challenging if they don't have an employer saying, here's the default.
Exactly, and do it for you. And I think that's where, at least a lot of Australians potentially are going with, you hear lots of job cuts in America with the big tech, and I can just see there's this rise of people doing, multiple different services and then going, I've either got to figure this all out my own and try and navigate it. But I think encapsulating, I guess finally, for those that have got questions and potentially want to reach out to yourself because you're endowed with a lot of knowledge and wealth of experience here, as I'm finding out. Where can people go to contact and learn more?
Look, the best, hard to contact me directly, but certainly good start.
Fortunate for me then.
Absolutely. Good starting point is the website, is art.com.au. There's a range of tools and paperwork there. again, a lot of people look at the material and go, oh, this is all too hard. Please pay attention to it. I remember seeing, it might have been Paul Clitheroe on the Today Show some years ago, where I think Carl Stefanovic said, oh, but Paul, no one reads the fine print. And Clitheroe leaned forward and said, Carl, it's your money. Read the fine print. Make the effort to read the fine print, and there's lots of tools there to help you work out, well, what sort of investments am I comfortable with? What sort of risk am I comfortable with? Where do I want to be? In different calculators you can try out, not just on super, but on your insurance as well, if you want to go down that path. There's also, if you join ART, or if you join another of the major super funds, you can get some limited advice from the super fund as well. When you get a bit more money behind you as an individual, especially as a young person, at some point seek financial advice. I think having a reliable financial advisor that you can engage with from time to time to make sure you're on the right track and to help you actually come up with a longer term plan is a very good thing. As I said, we find that of our members, those with advice end up with better outcomes. The evidence is pretty overwhelming.
I appreciate it. This has been an incredibly enriching conversation, at least from my point of view, and I'm sure listeners will have the same. But I appreciate you flying over to do more in person and just speak with me. But hopefully when you come back again, as you're sort of expanding the footprint, you can come back and we can have a long discussion.
Absolutely, love to. Thanks so much for your time. It was a great opportunity.
Thanks for listening to the Market Bull podcast. If you enjoyed it, please make sure to like and subscribe. You can follow The Market Bull on our socials at Twitter and LinkedIn by searching The Market Bull. You can also subscribe to our newsletter on the website by visiting www.themarketbull.com.au.